Please see the full disclaimer on your screen before we begin.
Welcome to This Explainer. Today, we're decoding the massive permanent split that's completely dominating the 2026 commercial real estate landscape. Look, if you've been watching the markets lately, you know the old playbooks. Yeah, they're being entirely rewritten. We are standing at a major turning point, and the decisions you make right now are literally going to define your portfolio's success for the next decade. So let's just jump right into the critical question. What on earth do you do with an underperforming asset in 2026? Gone are the days when you could just, ride out a market dip by holding on to generic office space. That just doesn't work anymore. Today, underperforming assets demand radical action. You basically have to choose: aggressively defend your capital or entirely reimagine what your asset is actually for. Here is our agenda for this explainer. First, we'll look at the 2026 market bifurcation, then the flight to quality offices, followed by the adaptive reuse pivot. After that, we'll compare risk and resilience, and finally, we'll figure out your portfolio's next move. Section 1, the 2026 market bifurcation. Right now, we are seeing this incredibly intense debate between two totally opposite philosophies. On one hand, you've got the flight to quality. This is all about stabilizing Class A office spaces in primary urban cores, fighting tooth and nail to attract high-credit tenants. But on the exact opposite side of the spectrum, you have adaptive reuse. Here, investors are pivoting completely away from traditional office space and turning toward things like hotel-to-housing conversions, mostly in secondary markets. It's a real fork in the road. Section 2, flight to quality offices. Let's talk about those high-end trophy assets. They are absolutely outperforming the broader office market right now, and it's largely being driven by what's known as the jewel box trend. Firms are shrinking down their massive, sprawling footprints and consolidating into smaller, super premium high-tech spaces. Think quality over quantity. And what's absolutely crucial here is sustainability. Things like compliance with local emissions mandates, such as Local Law 97, well, they aren't just nice-to-have perks anymore. They are absolute table stakes if you want to attract institutional tenants. To show you just how powerful this trend really is, let's look at the numbers. In major hubs, places like Manhattan, Class A vacancy has actually fallen over 400 basis points since 2023. That's 4%. That is a massive stabilization in rents and occupancy for these premium spaces. Investors are betting big that top-tier spaces will always attract that remaining pool of highly desirable tenants. But, okay, here's the hidden catch. While these high-end assets are definitely outperforming the broader market, the cost basis remains incredibly high. Sure, rents are hitting all-time highs in some key submarkets, but the sheer amount of CapEx, capital expenditure, required to keep up with those must-have de rigueur amenities, it's aggressively eating into investor margins. Yes, you are defending your capital, but the cost to stay competitive is just incredibly steep. Now, if pouring endless capital into fancy premium office amenities doesn't exactly fit your long-term goals, don't worry. There is an entirely different, highly solutions-oriented approach gaining massive traction right now. Instead of defending legacy assets, a lot of folks are looking at solving a very real nationwide problem: the housing shortage. Which brings us to Section 3, the adaptive reuse pivot. Investors are aggressively transforming properties, specifically hotels, to provide contract-based stability for workforce and senior populations. For workforce housing, old hotels are being repurposed to house workers for massive infrastructure and industrial projects. So instead of relying on transient night-to-night hotel stays, you get the amazing stability of occupants staying for weeks or even months on contract. And for senior housing, developers are realizing that hotels already have highly compatible, hospitality-focused floor plans. It's almost a plug-and-play solution. And the tailwinds behind this are just incredible. Thanks to historically low inventory growth across the country, independent living occupancy for seniors has crossed this massive 90% threshold. Honestly, that staggering demand makes these hotel conversions highly pencilable, meaning the math just works. And it's often way easier than trying to convert a massive, deep floor plate commercial office building into residential units. Speaking of offices, the broader feasibility index shows us that 23.4% of office buildings nationwide are now actually viable for adaptive reuse. That is a huge leap forward. That viability was finally unlocked by the lower interest rates we saw in early 2026, paired with some absolutely crucial government tax abatements. Literally almost overnight, these capital-intensive conversion projects actually started to make deep financial sense. Section 4, Comparing Risk and Resilience. So when we compare these two strategies side by side on this matrix, you can clearly see the trade-offs. The primary driver for a Class A office, that's tenant retention, basically fighting for high credit companies. For adaptive reuse, the driver is simply the massive supply-demand gap in housing. Financially, the office route offers high rent, sure, but it demands high CapEx and carries high credit risk. Housing conversions, on the flip side, offer lower turnover and really stable long-term yields. Now, zoning is generally pretty straightforward for offices, whereas housing conversions, they often force you to fight for rezoning and variances, which can be a headache. Finally, your exit strategy for offices usually points to an institutional sale, while adaptive reuse acts more as a stable cash-flowing asset. Section 5, Your Portfolio's Next Move. Ultimately, this is the stark choice you are facing right now. Are you going to play it safe, aiming for capital preservation in primary urban cores with those really expensive trophy assets? Or are you going to shift toward aggressive growth, chasing high-impact opportunities in suburban or industrial-heavy regions that are just absolutely desperate for workforce housing? The overarching lesson from the 2026 market is that the era of "if we build it, they will come" is officially over. It's done. It has been replaced entirely by evidence-based execution and a really deep, nuanced understanding of local shortages. The developers who are succeeding today are the ones constantly asking, what does this specific municipality lack? And then ruthlessly executing to fill that exact void. So as you look at the underperforming assets sitting on your own balance sheet right now, which of these two paths aligns with your goals? Are you going to double down on the high-end stabilization of trophy assets to preserve your capital? Or will you pivot to the high-impact conversion of underperforming inventory to solve a national crisis? At the end of the day, which of these paths will define your legacy in 2026?